Last week, we talked about the real power of having cash: liquidity, optionality, the ability to move when everyone else is frozen. And all of that is true. Cash is one of the most underrated tools in personal finance. But there is a point where the tool becomes the trap. Flip the coin over, and the same cash that protects you starts quietly working against you, not in a dramatic way, not in a way you would notice on a Tuesday morning, just a slow, steady erosion that does not show up in your balance, but shows up everywhere else. Here is the gap most people never see. Holding cash feels like the responsible move. It feels like discipline, like patience, like having your life together. What it actually is, past a certain point, is a guaranteed loss dressed up as security. So the question worth asking is not whether you should have cash, but you should. The question is how much cash is quietly crossing the line from protecting you to costing you. That line, and what happens on either side of it, that is what this video is about. Every month, you do not know where that line sits. The gap between your balance and your actual financial position gets a little wider, not suddenly, just permanently. My name is Alex, and if you have ever felt like your savings account should be doing more than it is, consider subscribing, because the number in your account and the value of that number are two different things. And I'm going to show you exactly how to find your real emergency fund target and what to do with every dollar above it. Once you understand where the line is, you stop confusing a big balance with a strong position. And that starts with understanding the three silent killers that are already at work the moment your cash crosses that line. Most people never question the feeling. And that is exactly where the problem starts. There is something deeply wired into us that equates a large bank balance with safety. It feels rational, it feels mature. But feelings are not math, and the financial system does not care about feelings. It runs on mechanics. So let's look at the actual mechanics of what happens when you hold more cash than you need. The first silent killer is not inflation. It is not opportunity cost either. It is something closer to home than both of those. It is your own psychology. Studies out of behavioral finance consistently show that people anchor their sense of financial security to the most visible number they have. For most people, that is their bank balance. And when that number is high, the brain registers it as a signal that things are fine. Spending pressure drops. Urgency disappears. The instinct to optimize goes quiet. Here is how this plays out in practice. Take someone like a mid-level project manager in his late 30s, pulling in around $91,000 a year. He has been disciplined. He has built up a $38,000 cash cushion over several years. Proud of it. Feels untouchable. But because that number looks so healthy every time he opens his banking app, small decisions start shifting. He upgrades the car lease. He books the nicer hotel. He grabs the subscription he meant to cancel. None of it feels reckless. Each call seems justifiable, and the balance, while not growing the way it should, never drops far enough to trigger a real alarm. That is the psychological trap in slow motion. The big balance is not making him safer. It is making him less careful, and less careful, compounded over 5 years, costs more than most people ever sit down to calculate. Now here is where it gets uncomfortable. This is not a discipline problem. It is a design problem. Your brain is doing exactly what brains are supposed to do. It reads available resources and adjusts behavior accordingly. The issue is that a cash balance in a checking account is a deeply misleading signal. It shows you the number. It does not show you what that number is actually doing, or more precisely, what it is failing to do. Which brings us to the second silent killer: opportunity cost. This one does not announce itself. There is no notification, no statement line, no moment where you feel it hit. It is purely the absence of something that should have been there. And absence is very easy to ignore. Here is the math, and it is worth slowing down for. Suppose you have $32,000 sitting in a standard savings account. In early 2026, the national average interest rate on a savings account sits at around 0.45%. That $32,000 earns you roughly $144 over the course of a year. That is not a misprint. $144 on $32,000. Now run the alternative. That same $32,000 invested in a broad low-cost index fund tracking the S&P 500 at a conservative historical average of 7% annual return grows to approximately $61,000 over 10 years. You contributed nothing additional. You just did not leave it parked. The difference between those two outcomes is roughly $59,000. That is not a small rounding error. That is close to a full year of pre-tax income for the average American household, sitting invisibly in the gap between what you did and what you could have done. And this is the part that does not get said clearly enough. Opportunity cost is not about greed. It is not about chasing returns or taking on reckless risk. It is simply the recognition that every dollar has exactly one job at a time. When you assign it to a savings account earning next to nothing, you have made a decision. You just made it passively, which means you probably did not feel like you were deciding at all. That passivity is expensive, more expensive than most people ever realize, because the cost never shows up as a line item. Your statement does not say missed growth this month, $412. It just quietly does not grow, and you move on with your week. Now here is the one that surprises people most, not because it is the largest in dollar terms, but because it is the most relentless. Inflation. In 2026, the US inflation rate is hovering around 2.7% annually. That sounds manageable, almost harmless. But here is what 2.7% actually means for a pile of cash sitting still. Every year, your $32,000 loses purchasing power equivalent to roughly $864. Not because the number changed, the number stays exactly the same. What it can buy gets smaller, every single year, without exception. Think about what that feels like in real life. If the median price of a new vehicle in the United States crossed $50,000 in early 2026, a few years ago, that same category of car was sitting closer to $42,000. Your cash did not shrink, but your ability to buy that car with your savings quietly did. The same erosion is happening on housing costs, grocery bills, insurance premiums, and medical expenses. None of it is sudden. All of it is guaranteed. And look, inflation is not a conspiracy. It is not the government stealing from you in some dramatic, overt way. It is just the baseline cost of a growing economy. But the baseline cost still applies to your account whether you understand it or not. Ignorance does not come with an exemption. So step back and look at all three of these together. Your psychology quietly tells you everything is fine when it is not. Your opportunity cost accumulates invisibly in the background, and inflation steadily chips away at the purchasing power of every dollar you leave untouched. None of these killers sends a warning. None of them trigger an alert. They just run, in parallel, every single day, against any cash that is sitting above the amount you actually need. That phrase, the amount you actually need, is doing a lot of work in that sentence. Because the real question this raises is not whether cash is dangerous. In the right amount, it is essential. The question is, how much is the right amount? And how do most people get it wrong? It turns out the answer comes down to a distinction almost nobody makes clearly. The difference between an emergency fund and what you might call a fear fund. And once you see the difference, the number you need becomes a lot more specific and a lot smaller than you probably think. Nobody sets out to build a fear fund. That is not what they call it. They call it being responsible. They call it having a cushion. They call it sleeping well at night. And for a while, that framing holds up. But at some point, the cushion stops being a safety net and starts being an anchor. And the difference between those two things is not a feeling. It is a number. Let's get precise about what an emergency fund is actually supposed to do. Not philosophically, mechanically. It exists to cover your essential living expenses during a period when your income stops. Job loss, medical leave, an unexpected disruption that takes you out of the earning column for a few months. That is the entire job description. It is not there to cover a bad month of spending. It is not there to fund a home repair you saw coming. It is not a general purpose buffer for life being expensive. It is a specific tool with a specific function. And like any tool, it only works correctly when it is sized correctly. Here is where most people quietly go wrong. They calculate their emergency fund based on their total monthly spending rather than their essential monthly expenses. Those are not the same number, and the gap between them is usually larger than people expect. Total monthly spending includes everything: dining out, streaming subscriptions, gym memberships, weekend trips, clothing, the spontaneous Amazon order at 11 at night. In a real emergency, almost none of that continues. You stop, you cut, you get lean fast. So, building a reserve large enough to maintain your current lifestyle through a crisis is not emergency planning. It is lifestyle insurance. And lifestyle insurance is expensive to carry in cash. The real calculation is simpler and more honest than that. Add up only the expenses that do not stop, regardless of what happens to your income. Rent or mortgage, utilities, groceries, not restaurants, health insurance, minimum debt payments, transportation costs tied to employment. That is the list. Everything else is optional in a genuine emergency, even if it does not feel that way right now. Take someone like a 36-year-old graphic designer in Austin, earning around $78,000 a year. Her total monthly spending runs about $5,400. She's been targeting a 6-month emergency fund based on that number, which puts her goal at $32,400. She is almost there, and she feels good about it. But when she actually sits down and strips her budget to essentials only, the number looks very different. Rent comes in at $1,400. Utilities run around $160. Groceries, not takeout, run about $320. Health insurance is $240 through her employer plan's COBRA equivalent. Car payment and insurance total $410. Minimum credit card payments add another $180. The real number is $2,710 a month, not $5,400. That is nearly half. A 6-month emergency fund built on that number is $16,260, not $32,400. She's been working toward a target that is almost double what the math actually requires. And every dollar above $16,260 is not protecting her. It is just sitting there, paying the inflation tax and the opportunity cost penalty we covered in the last section every single month. That gap between what feels like enough and what is actually required is precisely where the fear fund lives. A fear fund is not a bad intention. It is a good intention that has been allowed to grow past the point of usefulness. It usually starts with real anxiety. What if I lose my job and it takes longer than 6 months to find a new one? What if there is a medical emergency on top of that? What if the car breaks down and the roof needs replacing in the same year? These are legitimate questions, but the response to uncertainty cannot be an unlimited pile of cash, because an unlimited pile of cash has an unlimited cost in terms of what it is not doing. Here's the thing about worst-case scenarios. They stack their costs on both sides. If the catastrophe happens, you need resources. But if the catastrophe does not happen, and statistically, the specific combination of disasters people imagine rarely does, then you have paid the cost of preparing for it every single month in lost growth. The average job search for a professional in the United States in 2026 runs around 4 to 5 months. Not 12, not 18. And during that period, most people also cut discretionary spending significantly, which means the essential only number becomes even more relevant. So the math is not suggesting you be reckless. It is suggesting that you be accurate. The 3-step process to find your real number is straightforward. First, go through your last 3 months of bank and credit card statements and pull out only the expenses that would survive a genuine income stop. Be honest with yourself here. If it can be paused or canceled in a crisis, it does not belong on the list. Second, calculate the monthly total of what remains. Third, multiply that by a number between 3 and 6, depending on your situation. If you are in a stable industry with transferable skills and a strong network, 3 to 4 months is defensible. If you are self-employed in a volatile sector or carrying dependents, lean toward 5 to 6. That final number is your target. Not a penny less, because below that line you are genuinely exposed, but not a penny more, because above that line, you are paying a cost you do not need to pay. For our designer in Austin, that target is somewhere between $8,130 and $16,260, depending on her risk profile. She currently has $29,000 in cash savings, which means she has somewhere between $12,000 and $21,000 sitting idle above her actual emergency threshold. That is not a small amount of money. At a 7% annual return over 10 years, the midpoint of that idle cash, call it $16,000, becomes approximately $31,500. She is not spending it. She is not losing it. She is just not letting it do anything. And doing nothing has a price. This is the moment where the emergency fund conversation ends and a different and more interesting conversation begins. Because once you know your real number, once you have drawn that line accurately, everything above it stops being a safety question and becomes a deployment question. The question is no longer how much I should keep. The question becomes, where does the rest go? And how do I make sure it is actually working? That is where most people feel the most uncertainty. And it is also where most of the real long-term difference gets made. Because putting that extra cash to work is not about picking stocks or timing the market. It is about understanding the straightforward options available to you and why doing nothing is always the most expensive choice of all. The hardest part of this conversation is not the math. The math is actually straightforward once you run it. The hardest part is the moment right after you realize you have idle cash sitting above your real emergency threshold, because that is the moment the fear shows up. And the fear sounds very specific. It sounds like, what if I move that money and the market crashes next month? That question is worth taking seriously. Not dismissing, not minimizing, actually examining, because the anxiety behind it is real, and it deserves a real answer rather than a motivational speech about long-term thinking. Here is the honest answer. Yes, markets go down, sometimes significantly. The S&P 500 dropped roughly 19% in 2022. It fell by 34% in about 5 weeks at the start of 2020. These are not hypothetical risks. They are documented, recent, and uncomfortable to look at directly. But here is what those numbers look like on the other side. An investor who stayed in a broad index fund through the entire 2020 drop and did not sell recovered fully within about 5 months. By the end of that same year, the S&P 500 was up over 16% from where it started in January. The investor who moved to cash at the bottom of that drop in March, waiting for things to feel safer, largely missed the recovery. And the recovery is always where the real damage of panic gets done. Now compare that to inflation. Inflation does not recover. It does not have a bounce. It does not offer a re-entry point. In 2026, sitting in a standard savings account, earning around 0.45%, while inflation runs at 2.7%, means you are losing approximately 2.25% of purchasing power every single year. That loss is not a possibility. It is a certainty. It is happening right now on every dollar that is sitting still. So the actual comparison is not cash versus a risky unknown. It is a guaranteed loss of 2.25% annually versus a historically positive return that comes with short-term volatility. That framing changes the conversation entirely. The question is not how to avoid risk. The question is, which risk am I more willing to accept? Once that reframes itself in your head, the next question becomes practical. Where does the money actually go? The answer depends on one thing more than anything else: your time horizon. When do you reasonably expect to need this money? That single question sorts almost every option worth considering. For money you might need within 1 to 3 years, the goal is not growth. The goal is to yield without locking yourself in. 2 options are worth understanding here. The first is a high-yield savings account, or HYSA. In early 2026, the better online banks are offering rates between 4.5 and 5.1% annually on these accounts. That is not transformative, but it is meaningfully better than the 0.45% national average. The money stays liquid. There is no penalty for withdrawal, and you're at least keeping pace with or slightly outrunning inflation, rather than falling behind it every month. Actually, the second option for shorter time horizons is certificates of deposit, or CDs. A CD locks your money for a fixed term, typically 3 months to 2 years, in exchange for a guaranteed rate. In early 2026, 12-month CDs from competitive institutions are offering rates around 4.7 to 5%. The trade-off is access. If you need the money before the term ends, you pay an early withdrawal penalty, usually a few months of interest. So CDs work well for money you have identified as not needed in the near term, but not yet committed to long-term investments. For money you are genuinely setting aside for 10 years or more, the calculus shifts. This is where broad, low-cost index funds become the straightforward answer that most people overthink. An index fund does not require you to pick stocks. It does not require you to have a view on which sector will outperform. It simply holds a slice of the entire market and moves with it over time. The expense ratios on the leading index funds in 2026 sit at around 0.03% annually. That is $3 per year on every $10,000 invested. The cost of doing this is essentially nothing. The historical average annual return of the S&P 500 over any rolling 30-year period, adjusted for inflation, sits around 7%. That is not a promise. Past performance is not a guarantee, but it is the most reliable long-run data set available in personal finance. And it has held across recessions, wars, pandemics, and political transitions. Here's what 7% does to a concrete number. Take someone like a 41-year-old civil engineer in Ohio, earning $104,000 a year. He has done the emergency fund calculation and identified $22,000 sitting idle above his real threshold. He moves that money into a low-cost index fund and does not touch it for 20 years. At a 7% annual return, that $22,000 becomes approximately $85,000. He contributed nothing additional. He made no active decisions. He just moved it from a place where it was losing ground to a place where it could grow. The other option worth mentioning, and arguably the one with the most immediate impact for most people, is maxing out tax-advantaged retirement accounts. In 2026, the contribution limit for a 401k, that is, your employer-sponsored retirement account, sits at $23,500 per year. The limit for an IRA, or individual retirement account, is $7,000. These accounts do not just offer investment returns. They offer a tax structure that compounds the benefit of every dollar you put in. A traditional 401k reduces your taxable income today. A Roth IRA grows tax-free, meaning you pay no tax on the gains when you withdraw in retirement. Either way, every dollar deployed here is working harder than a dollar, sitting in a savings account earning less than 1%. And look, none of this requires becoming an investment expert. It does not require watching markets, reading quarterly reports, or having opinions about interest rate policy. The entry point is simpler than most people assume. Open an account. Choose a broad index fund. Set a contribution. Let time do the work that feels like it should require more effort. Here's the thing about that simplicity. It runs against everything the financial industry is designed to make you feel. The industry benefits when you believe this is complicated. Complexity justifies fees. Uncertainty justifies advisors. Anxiety justifies products. But for the large majority of people with idle cash above their emergency threshold, the right move is genuinely not that complicated. It is just unfamiliar. Unfamiliarity is not the same as danger. It just feels that way at first. And once you start to see your money not as a balance to protect, but as a collection of assets with different jobs, some liquid, some growing, and some compounding inside a tax shelter, something shifts in how you think about your finances overall. That shift is not just mechanical, it is a change in identity. The way you measure your own financial health starts to look different. And that difference between how a cash accumulator sees money and how a wealth builder sees it turns out to matter more than any single account decision you will ever make. Here is what this all comes down to. Cash is not the enemy. Misallocated cash is. The feeling of security and the reality of security are two different things. And for a long time, the financial system has benefited from you confusing the two. A few things are worth carrying forward. Your brain is designed to read a large balance as safety. That instinct is not wrong. It is just incomplete. Inflation is not a risk you can opt out of. Every dollar sitting still is already losing ground. The line between a safety net and a drag on your financial position is a specific number, and most people have never calculated it accurately. And the cost of doing nothing is never zero. It just never shows up on a statement. So here is what to watch for going forward. The next time you feel reluctant to move money out of savings, ask yourself whether that reluctance is coming from a plan or from a feeling. Those are very different starting points. There is a related question worth sitting with for next time. If idle cash is quietly costing you, what else in your financial life is running a hidden cost you have not measured yet? If this helped something click, share it with someone who is still equating a big balance with a strong position. They are not the same thing.